This is the second video in the series. The first one was understanding your profit and loss, and this one is understanding your balance sheet for business owners. All right, so the balance sheet basically shows the cumulative totals for all time at one point in time. So if you think of a checkbook, which I know is a little old-fashioned, but the idea of it, right, a bank balance, if you look at your current balance, it's the sum of all the ins and outs that have happened over time up until the day you're looking at it. And the day you're looking at it is showing you what's in it right now, but it's the sum of everything. And if you've had the bank for 5 years, right, it's the sum of all the deposits and all the withdrawals you've made over the last 5 years up till today. So the P&L, the profit and loss, is from a start date to an end date, and then it totals that activity. The balance sheet is a flow of in and out information all the way along as far back as that balance sheet started from, whatever start date that balance sheet started from, all the way until whatever point in time you're looking at it, not a sum of all the activity, but the ending balance of each of the accounts that you're looking at as of the point in time where you're looking at it. So it gets a little confusing because sometimes people look at their balance sheet and don't understand why some of the numbers look the way they do, or are expecting then that means certain things that it doesn't. That's just the number that is the cumulative number for that account from the beginning of time. It's one of the main business reports that a business owner looks at to see how the business is doing. Well, it should be, right? Actually, a lot of people skip right over the balance sheet because they don't really understand it. They don't know what it's telling them. They don't know what it means. So hopefully after they watch this video, after you watch this video, you'll be able to look at your balance sheet with much more understanding, and it'll be much more useful to you. Best way to think of it is to understand that it's basically showing what the business has compared with what it owes. And if it has more than it owes, then you've got a good business. It's got a positive net worth. If it turns out you owe more than you have, that's not so good. That means you have a negative net worth in the business. And the best way to look at the balance sheet is not as a point in time, although that's how we tend to send the reports. But really, the best way to look at it is in comparison. Over periods of time, you can see changes and make determinations from what those changes are telling you. So feel free to request a balance sheet compared to a prior period or prior month or over the course of the year by month. That's going to give you the best insight into what's actually going on with the business. All right, so what is the balance sheet? It has two main sections, assets and then liabilities and equities. So one section, one half of it is assets, things you have. The other part is liabilities, things you owe, and equities, things that you put in or taken out. So the basic balance sheet equation is that assets must equal liabilities and equities. They have to balance. If you have 100 total in assets, then you have to have 100 total when you add up liabilities and equities. They have to be the same. If they're not, something is fundamentally broken in the accounting. And this is the origin of double entry accounting. Every time you make one entry, you have to make another corresponding entry. If you don't, automatically, right, things are going to be out of balance. So everything that you enter in accounting has to actually have two entries, two sides to it. Now, with software like QuickBooks, you don't actually go in and make two entries. The software does it based on the inputs that you're giving it. It splits it into two parts, but you can go in and see the detail and see where each half of every single transaction ended up if you're trying to, dive in deeper, which you don't have to do as a business owner, but on the accounting side, it's what we're doing to make sure everything worked out correctly. So let's talk for a second about what are assets. Basically, you can think of them as things that you own, cash being the number one, right? Cash is an asset that the business has that has value. Accounts receivable is not cash today, but it's a promise to get paid cash. Equipment and vehicles are things that you have paid cash in the past or borrowed cash in the past to have in the business. There are things that you own that you use to operate the business, and they have intrinsic value. Then there's intangible assets, software, trademarks. There's also inventory, which isn't on this list, but is another asset. And then money that you paid ahead, like prepaid insurance payments or security deposits that you paid ahead, that rent, but rent that hasn't come due yet or is held in escrow, essentially, if you fail to make a rent payment. And that if you've loaned people money, then you're waiting to get paid that money back, and you hold that note that says they're going to pay you back. All these things are assets. Now, what's the flip side? What are liabilities? Liabilities are things you owe. Bills, right? You got something from somebody, you haven't paid for it yet. Credit cards, you spent money on a credit card, you have to pay it. Sales tax, you've collected, you have to pay it to the government. Loans, you borrowed money, you have to pay it back. Payroll taxes, you've withheld it from your employees' checks, but you haven't paid it to the government yet, so you can do that. Those are all things you owe. And then the last part of it, liabilities and equities. Equities you can think of as your position in the business. Profit and loss, right? If you've made money or if you lost money, that's part of how you've done with the business. Money invested into and distributions taken out of the business. And then money that you have that you haven't yet pulled out of the business, maybe profits you made the prior year, haven't pulled it out yet. The difference between assets and liabilities is you can think of the book value of the business. So if you have $1,000 in assets, $800 in liabilities, then you have a $200 book value for the business. Because if you paid off the liability, so that was zero, you would have reduced the cash from 1,000 down to 200. That would be the remaining value in the business. That's the book value. Now, a lot of times book value is totally different than market value, but for purposes of determining positive net worth or negative net worth, people look at your book value, and hopefully, again, that's a positive number. So let's just take a basic look at how the balance sheet works, just thinking of it as a seesaw. Let's imagine that you just start this business on day one. You open a business checking account, you put $100 in. This is what it looks like. You have $100 of cash, that's your asset. And then on your balance sheet, you have credit for having put $100 in. That's your equity in the business, the $100 that you put in. That's the double entry in the books. $100 plus cash, $100 plus equity, it balances. Easy. Now, this hasn't actually done much yet for us, but that's the starting point. Now, imagine you took $50 of that cash that you put in and bought $50 worth of products you can then resell. So all we've done is split our assets into two parts instead of one. We have $50 of cash, and then we just spent $50 of inventory, and hopefully that inventory was worth $50. We're assuming it is. So we didn't have an expense yet because we haven't sold the inventory. We're still holding the inventory, but now we have two kinds of assets offset by the same single $100 investment. Now suppose we took that $50 of inventory and we sold it for $100. So our cash went from $50 to $150. Meanwhile, our inventory went from $50 to zero because we don't have it anymore. Now on our profit and loss, what we record is $100 of revenue minus $50 of cost of goods sold, because our inventory becomes an expense once we sell it, equals $50 of net income or $50 of profit. So now our balance sheet is once again balanced. We have $150 of cash, all the inventory is gone. We have $50 of net income, net profit that we made from selling that inventory, plus the original $100 of equity that we got for putting the original $100 of cash into the business. So it's balanced, 150 on one side, 150 on the other side. Everything looks good. Now, suppose you needed more money, you wanted to buy more inventory. Let's say you had that same original $100 of cash and $100 of investment, but you borrow an additional $400. So what happens? Now your cash goes from 100 to 500. So 500 in cash, original $100 investment still there, but now on the liabilities side, you have $400 of debt. And once again, 500 cash assets, 500 cash, or 500 total liabilities and equity, everything balances. It's working. Now, how does credit cards work? Because with credit cards, you're getting stuff, but you're not adding anything in the bank, right? So in that case, let's say you had $100 of cash in the bank, and then you put $400 of expenses on your credit card. So now you have $400 of credit card debt. How does that offset? Well, you had $400 of things that you bought for the business, not inventory, because that would be on the asset side. But, maybe you paid for some travel, some meals, some marketing expense, whatever it was, expenses. Right. So now you do your profit and loss. So far, no income, $400 of expenses. That means your profit so far is minus $400. And that goes on the balance sheet. 400 credit card debt, minus $400 net profit, $100 original investment, everything balances. Now, instead of using the debt for cash, you bought a very nice $400 car. So now on the asset side, we have $100 of cash, and the $400 car that we bought to operate the business. Granted, it's probably not much of a car, but for this example, keeping the numbers simple. So $100 of cash, $400 car. On the other side, $400 of debt. We got, zero down on this $400 car. So that was pretty good. And $100 of our original investment. Once again, assets and liabilities and equity are in balance. Now, suppose we go out and make a bunch of sales, but we don't actually get paid for those sales. How does that affect things? Well, now we have $100 of cash. We have $400 of invoices, which are pieces of paper that we're holding that say our customers are going to pay us at some point in the future. But assuming we are going to get paid, we count those invoices as revenue. We record our profit and loss with $400 of revenue, even though we haven't collected it yet. No expenses, so $400 of net income, and then $100 original investment. Once again, everything pans out. Now, suppose we had 200 of those $400 worth of invoices, and those customers said, you know what? You guys did a lousy job not paying. What would we put on our P&L? Well, we'd still have $400 of invoices, but then we would have $200 of bad debt expense, and that would leave us with just $200 of now net profit. So invoices would come down, net income would come down, everything stays balanced. Finally, distributions versus taxable income, one of the trickiest kind of concepts to understand. Suppose in this case, we had bought some inventory and sold it and generated a profit. And we had $500 in cash, and then we had $400 in net profit from that and $100 of investment. But we decided, hey, business is doing great. I'm going to take $400 out of the business and pay myself. Great. So $400 comes out of cash, and now cash is back to 100. And on the liabilities and equity side, we have a minus 400 distribution. So we don't reduce the net profit because the business did make money. It had a profit. That's income minus expenses, nothing to do with us paying ourselves. Separately, we take 400 out in distributions. That's our benefit from being an owner of the business, or owner's draw, or shareholder distributions, or partner distributions, depending on what kind of business you have. But bottom line is the same thing, right? $400 cash comes out for being the owner, and that's recorded. Now, we still have net income from the actual operation of the business. And that net income is the part that you pay taxes on, not the distributions part. So what's tricky about this, or what people get confused about, is they say, well, what if I leave all the money in the business? Or I never paid myself anything, so why would I owe taxes? Well, taxes is based on that net income number. Income minus expenses has nothing to do with whether or not you paid yourself. Or in other cases, people say, I took all the money out, even though, and my business was profitable, but I took all the money out. Well, you still pay taxes on the net income, whether you left all the money in or you took all the money out. It is separate, and the balance sheet is kind of showing you why from the net income, right? If you left all the cash in, cash would be a bigger number. There'd be no distributions, there'd be a smaller number. Where you took all the cash out, distributions would be a bigger negative number, and cash would be a smaller number or zero. But bottom line is the net is what you're actually taxed on. So leaving money in or taking money out of the business doesn't have an impact on the taxes if what you're leaving it in or taking it out for is owner's compensate or owner's draw, owner's distributions. So confusing a little bit, but I think the balance sheet helps make it a little bit clearer. The other thing it should hopefully make clear is that the cash, you can't take more cash out of the business than ever was, right? Because then again, you'd be out of balance. So you can only take cash out down to zero. And then after that, you have a problem with your balance sheet being out of balance. All right, so this is what a basic balance sheet looks like, a little bit more like you're used to seeing it, but very basic. So just from looking at this, we can kind of see or come up with a story around here's what happened. Let's say we started this business out with a $2,500 loan from a friend. All right, so we put it on the books, $2,500 loan. Then we spent, and that would have had $2,500 in our bank account, offset by $2,500 loan. Then we spent $1,500 on various startup expenses, which, because we didn't have any money coming in yet, means our net income is minus $1,500 because we just had expenses. And that leaves us where we are right here. We have $1,000 in the bank. Great. That's the sum total of our assets. We have a loan. We owe $2,500. We have net income of minus $1,500 because we bought some stuff for the business. None of it was assets, so it's not on the asset side, it's just expenses. So we lost $1,500 so far. And that leaves us with total equity, liabilities and equity of $1,000. If right now we had to pay that loan back, we'd be in trouble because we only have $1,000 and we still owe 2,500. But hopefully that 1,500 we spent to get the business up and running will then allow us to make some money, be able to bring some more cash in and start making payments on the loan. It's a very basic balance sheet, but follows the same principle as the seesaw sort of images we were just looking at. Assets equals liabilities and equity. Money comes in, money goes out, it balances. So here's a bigger balance sheet, a little more activity. Bank account, 2,500, accounts receivable, 3,000. We also have some equipment in this business. On the liability side, we have $3,000 we owe to American Express, $2,500 we owe on a loan still. Owner's draw, we've taken out $1,500 to maybe pay our own bills to live on. And then we also have a nice net income of 6,500. So notice the bank account number, 2,500, and the net income number are not the same. Don't look at the net income and expect to see that much in the bank. Just because you've made profits of a certain amount, that doesn't mean that's how much is still in the bank. We might have used some of that money to purchase the equipment. So it's not a direct relationship between what's in the bank and how much profit the business has made. And as you can see, this balance sheet is perfectly in balance, even though those two numbers are $4,000 apart. So those are not the same thing. Bank account and balance and profit are not the same thing. All right, so let's talk about depreciation, which is one of the things you'll see on the balance sheet and sometimes gets a little confusing. So this is the same balance sheet we were just looking at. You can see we have $5,000 of equipment that we bought. Normally, assets, when we're talking about equipment, we want to put things on there that are $2,500 or more and have a useful life of 1 year or more. So something that's $500, even if you're going to use it for the next 5 years, like a used laptop, we generally would just count as an expense, not count as an asset. On the other hand, if we bought a big piece of equipment for our construction business that was $5,000 that we're going to use for more than a year on lots of different jobs, that we would count as an asset. So it doesn't reduce our profit because we're expecting to use it over and over again and not just count the expense for that one time right when we bought it. But the IRS does give us rules that lets us count it as an expense using something called depreciation. So what happens is, depending on the amount and how much you've already expensed and everything else, the kind of equipment it is, et cetera, you can each year write off a certain amount of fixed assets all in that first year, even though you'll be using that equipment for years to come. And that's called depreciation. The way we put it on the balance sheet is we don't take the equipment off and we don't reduce the value that we bought it at. Instead, we add a line for accumulated depreciation, whether that's part of what the equipment value is or the whole amount. So in this case, we have $5,000 of accumulated depreciation. That's a negative that we add to our assets, which reduces the asset value by that negative amount. On the other side, liabilities and equity, the way it balances is because depreciation counts as an expense. So our profit and loss, while our net income was $6,500 a minute ago, when we add that $5,000 expense for depreciation, now our net income drops to $1,500. And all of a sudden, we're back in balance. So depreciation is what's called a non-cash expense. It reduces our profit, reduces the amount we pay tax on, but we don't actually pay cash out to pay depreciation. It's just something that the IRS allows us to do for fixed assets that do, in fact, lose value over time, but maybe not at the speed that we're allowed to write them off. All right, now let's look at how loan repayment works. So again, here's the same balance sheet with a $2,500 loan, and you'll notice in the bank account we have $2,500. Well, if we pay that loan down to zero with the money in the bank account, everything stays like where it should because the bank account is now zero, but also the loan is now zero. So again, everything stays in balance. Do you ever expect to see a loan that goes below zero? What does that mean? It would mean, in fact, that now instead of you owing them money, they owe you money, which, normally never happens. So when you look at your balance sheet, if you see a loan balance that's negative, or for that matter, a credit card balance that's negative, you figure either the books haven't been fully updated yet, or the loan was paid off, but they were including interest along with the loan payments and didn't take that back out and count it as an expense, not on the balance sheet, or something else is going on. But it's something that needs to be fixed because no loans or credit cards should go below zero because that wouldn't make sense, right? The credit card's not going to owe you money. The Lender's not going to owe you money. Something else happened there. Now, distributions, like we were just talking about before, how does that work? So let's say on this balance sheet, you have $20,000 in your bank account, and you have something I've added here now called retained earnings, which is $20,000. Retained earnings is just the cumulative net income, profit or loss, all the way along up until the start of the current year we're in. So the date at the top of this, February 28th, 2025, the retained earnings is everything this business made all the way up through December 31st, 2024. So this is money the business made in prior years, separate from net income, which is the money that we've made from the start of this year through till today, or whatever time period we're looking at it. So in this case, this business has 20,000 bucks in the bank account, and it has $20,000 of retained earnings. And now the owner, let's say it's you want to take some of that money out and use it for things that aren't related to the business. So let's say you take $19,000 out of the $20,000 out of the business. Transfer that money to your personal checking account. On the liabilities and equity side, what happens? Your owner's draw goes from minus 1,500 to minus 20,500. So your retained earnings didn't change because that's still true how much the business has made in the past. Your net income didn't change because that's still how much profit we've made from January through the end of February this year. What's changed is the owner's draw. So you pay taxes on net income. That number hasn't changed by taking money out of the business. Your prior year's profit and loss hasn't changed by you taking money out of the business. The only thing that's changed is that owner's draw has changed, and your bank account, the cash available, has changed. All right. So again, taxable income, let's say in this case, you have $21,000 in the bank. You have $21,500 net income through the end of the year, December 31st, 2025. Now you want to take out money. So again, you take out $20,000 out of the bank account, you pay yourself $20,000. So now your owner's draw is 20,500. It went up by 20,000. But again, your net income hasn't changed, and that's the amount you pay tax on. So you could have left the money in the business, like on the left side here, or you could have taken the money out of the business, like on the right side, but neither of those actions changed the net income. Therefore, they don't change or impact what you're going to be taxed on, because each year you're taxed on your profit or loss, the net income for the year's results of operating the business, separate from and independent of the distributions that you might take out of the business. So hopefully, if nothing else, that question becomes a little clearer in understanding your balance sheet, what you owe for tax, and the impact of leaving money in or taking money out of the business. All right. Now, lastly, I had said looking at the balance sheet over time is the most useful way to kind of understand what's happening in the business and the impact. So if we look at this business, starting with the bank account, you can see money goes up, money goes down, right? From month one to month two, balance went up a little bit. Month two to month three, balance has come down by a fair amount. Accounts receivable, though, keeps going up. What does that mean? You're doing a lot of business, you're writing more invoices, and doesn't mean that 3,000 in month one, none of that got paid. Some of them might have gotten paid, or all of them might have gotten paid. But by the end of month two, you have at least $5,000 of invoices. So some of those ones from month one might have gotten paid. And in the meantime, you've written more invoices. And by the end of month two, you now have $5,000 of money owed to you by various customers. And by month three, $8,000 of money owed to you. So it's good on the one hand because it means you're making sales, but from a cash flow standpoint, getting a lot of people who owe you money is not necessarily going to help you pay the bills, right? You want to be able to collect those invoices. Now, if you look at the third line, equipment, we started with 5,000, which we have written off the depreciation for. And oftentimes depreciation is only entered once a year at the very end of the year. So in month two, we bought another $500 worth, and month three, another $500 worth, which is, for this example, as I mentioned earlier, normally it's $2,500 is the threshold for adding equipment. But just to make the spreadsheet here make sense, we've added some equipment, but the depreciation hasn't changed because, again, we typically only do that once at the end of the year. So in this case, for the business, the total assets have climbed from 5,500 to 10,250 over the course of 3 months, largely because of the growth in accounts receivable. That added $5,000. Cash actually has come down. Now, on the liabilities and equity side, what you can see happening is the Amex card, $3,000 was owed month one, $4,000 in month two, $6,500 by month 3. Now again, like invoices, this doesn't mean that you made 0 payments month 1 and added $1,000 in month 2. You could have paid the entire card off month 1, but then turned around and ran up another $4,000 of expenses month 2. Same thing in month 3. Or you could have made partial payments plus additional expenses, but bottom line, the amount owed at the end of month 2 was 4,000. At the end of month 3 was 6,500. So that balance has been growing. The amount you owe has been growing. And that's probably because you've been doing more business, incurring more expenses, but not collecting all of them, right? So business has been growing, but money hasn't been coming in. So you've been having to borrow more. Now, at the same time, on the next line, that loan you had for 1,500, you've been making $250 payments. So from month 1 to month 2, it went down by $250. And again, another $250 from month 2 to month 3. So as the loan balance goes down, it means you're paying down the loan. You're increasing your ownership in the business and reducing the amount of money that you owe people. If you were to liquidate the business, the less you owe, the more of whatever you have in assets you're going to end up keeping, because you don't have to pay it back in loans. Now, owner's draw, this is where it gets a little confusing. In month 1, so far, we had drew 2,500. In month 2, it's still 2,500. So what does that mean? It means when there's no change, nothing additional was taken. So at the end of month 1, we'd drawn 2,500. At the end of month 2, it's still 2,500. That means in month 2, the owner did not take any cash out of the business. In month 3, it's now 2,750. That means during month 3, he took out $250, because again, remember, a balance sheet is the sum of the activity through that point. So when there's a month where nothing changes, that means nothing was added or taken out. Or if money was added and taken out, it netted to 0 change. So 2,500 an owner's draw from one month to the next means no additional money was taken out month 2, and only $250 was taken out in month 3. And then net income is the same thing. Through the end of month 1, the business had made $3,500 of profit. Through the end of month 2, it has made $5,500 in profit. So that doesn't mean from the start of month 1 to the end of month 2, it made 3,500 plus 5,500. It means over the course of time, from the beginning of time on this through the end of month 2, it made 5,500, right? So it's not additive, it's the cumulative result at that point. Between month 2 and month 3, it made 0 profit. How do I know that? Because month 2 profit or net income and month 3 are identical. There is no change. So just like the owner's draw only went up $250 from 2 to 3 and $0 from month 1 to month 2, net income from month 2 to month 3 didn't change. So that means from month 2 to month 3, the business made no additional profit, didn't have a loss, but it didn't make any additional profit because that number didn't change. And likewise, the liabilities and equity match the assets each month. They have grown over time. What's driving the growth on the liability side is largely the increase in the Amex account, and yeah, that's the biggest change. And then the net profit went up by $2,000. So $3,500 growth on the Amex balance over from month 1 to month 3, and a $2,000 growth in the net profit from month 1 to month 3. Those combined additions grew the liabilities and equity to match the growth in the total assets, so they're always in balance. So when you look at your own balance sheet, hopefully this now makes a little bit more sense. You understand more of what the numbers are telling you, how you look at it month by month over time and see those changes. But of course, if you have questions, we can help. We can help interpret it for you, help you understand what the data means, and help you make sense of it to make good business decisions. Thank you.